Now is Nimesh Shah, MD and CEO of ICICI Prudential Mutual Fund. Nimesh, good morning. Good to have you on the show. The story of last year was about domestic investors really pumping in a lot of money in equity markets. Do you think that trend has remained intact? Have we seen inflows even at all-time highs?
Yeah. What if you see last 1 year also, we started the year at around $1 billion of net inflow every month. We have ended the year with almost $2 billion of inflow every month. So around, if you see the gross sales, is also double by the time the year ended. So we have in the month of February, March around 25,000 crores of gross sales as an industry, and the net sales would be anywhere around 10 to 12,000 crores month on month.
Okay.
So this is a very good inflow that is coming into the markets.
Nimesh, good morning. Thanks a lot for joining us on what's a special day every month. What's your sense about how retail investors behave typically? When you see all-time highs, do people sell more or buy more? I mean, give you more money.
Historically, psychologically, across the world, as the markets go up, the flows always increase. Unfortunately, that should not be the case. But we need, as AMCs, as responsible AMCs, we need to restructure our products. That it's a fact of life that as the markets come near 30,000, as they cross 30,000, you will see more and more retail customers coming in. My customer base is increasing every month. If you see last 2-3 years, especially the last 1 year, the number of customers that we have, the number of investors that we have has doubled in the last 3 years. Right? That's the kind of inflow of new people also coming into the markets. So we need to be careful. The whole thing is that the expectations are too high. We are trying to mellow down the expectations. We are getting people, more and more people, into dynamically asset management products, so that when the markets are at a very high level and the flows come in, you get them into a mix of debt and equity, allocate more towards debt, and as the markets correct, in a flow-based market, as the markets correct, you will allocate more and more into equity.
Okay, interesting. Nimesh, hi, good morning.
In fact, we are coming with a NFO right now, but we have not promised.
Sure, go ahead.
Yeah, okay.
Go ahead. You were telling us about your NFO.
Yeah, so recently we are coming out with the NFO, but we have told the investors very clearly that at the timing of we are taking the money now, we'll invest somewhat in the infrastructure sector, etc. But we will ensure that the dynamic asset allocation model works in our new NFOs also. That's what, so we will not invest fully into the markets at this level. We'll wait for the right opportunities to come up, and then we'll come up with that. So it is important to have a mix of debt and equity right now rather than going only for equity.
Okay, I also wanted to congratulate you because I understand you won the best equity house by Morningstar in FY17. So congratulations to you and your entire team. Wanted to ask you what your view is going ahead, because you've been telling us that there's more value in large caps compared to mid caps. But in the year gone by, or in the last 2-3 years, we've seen the mid and small cap funds give us great returns, whether it's your own fund or even some of the other funds, like the DSP BlackRock fund or the Sundaram multi-cap fund, etc. Going ahead, do you still see a lot more value in large caps compared to mid caps, or do you think that trend is changing a bit?
Yeah, last 1 year we have gone completely wrong on that, but we continue maintain our stand. That we believe that in the risk return profile, we still believe, and as the returns, past returns are better in mid caps, all the more reason to be more into large caps. So that we maintain, even after going wrong, we maintain it more strongly that this is the time to be in large caps, and mid caps are too over, vis-a-vis the risk return does not set into mid caps right now.
Okay. You were speaking about how you ask new investors to put their money in dynamically managed funds. Is there any other fund you would recommend at this time, say balanced? If not NFOs, in existing funds, what is the category that
one is the balance?
Yeah.
So one, strongly retail investors, I strongly advocate dynamic asset allocation like Balance Advantage Fund, ICICI Prudential Balance Advantage Fund. Other fund which for equity investors who want to invest equity lump sum right now, we have suggested as a kind of contra is ICICI Prudential Infrastructure Fund. I think infrastructure is the sector that they can go for with a 2 to 3 year paradigm. And power, we have taken a call on power, we have taken a call on telecom, we have taken a call on road, and I think those contra calls will make money.
Okay, contra calls making money. But
Because power, if you see today, the capacity utilizations are so low. Yeah, capacity utilization in the power sector or the cement sector are low. I think in the next 2 to 3 years, the capacity utilizations will be better than what they are today. And then the operating leverage will work out and their earning per share is expected to grow. And if that happens, then we have to follow earning per share, whichever sector we believe will grow in the next 3 years.
what about IT, Nimesh? That's again a space which has not worked. Do you think it could be the year of IT stocks?
We are underweight IT in the sense that not because so much on the basic business model as they figure out what they are going to do from the mass vanilla product that we are in today, as it gets more and more specialized and the current scale. So we have gone underweight on IT. Even though IT appears to be cheap, we have gone, and with the rupee also at 65 right now, or less than 65 or 64.4, whatever you are saying, I think IT we are not overweight. We would rather play that with pharma rather than IT. Because I believe pharma companies have got that fundamental strength that over a period of next 2-3 years, they will overcome their FDA challenges. And if I have to play the international markets, I'll play it through pharma rather than IT.
Okay, before we wrap up the conversation, there were a couple of themes that you had spoken to us about the last time. One of them was logistics. The other one was the general insurance companies that you like. That theme has played out very well, but now there are some concerns emanating on both the demand situation as well as on valuations. Is this still a theme that you're playing?
See, that if you have to play, you have to play it through the private banks or the NBFCs which hold those insurance company shares. So that continues. The private banks is something that we have always liked and we still maintain. With government banks having 70% of the market, they have got market share to gain. So whether it is retail private banks or the corporate private banks, which are available relatively cheaper today. So private sector banks and NBFC, selectively NBFC, the conservative NBFC. See, NBFC has got a huge opportunity as private banks because the government banks won't be lending as much as they were lending earlier. So between these two guys, if they are conservative and they can underwrite credit well, I think NBFCs as well as private banks have got a very good opportunity.
All right, Nimesh, it's always a pleasure having you with us on the channel. Thank you. Sorry. Okay. Thank you very much, Nimesh Shah, for joining us and celebrating Mutual Fund Day with us. It's a quick break.